Gold prices have crashed. Gold prices have crashed. Since 2011, gold has plummeted more than 25%, and the worst may not yet be over. The Profit Strategy newsletter at ETFguide.com warned its subscribers the gold bubble would pop, and it has. Our gold alert given to subscribers in early 2013 resulted in a 500% gain. What happens next in the gold market will shock the entire globe. Join today at ETFguide.com and get a $50 bonus by using promo code SAVE50.
You're listening to the Index Investing Show. This is America's only weekly program focused on the important stock and bond indexes and the financial products that track them.
And now presenting your host,
Ron DeLegge.
Welcome to the program. I'm your host, Ron DeLegge. We'll be talking the birds and the bees of successful investing coming up on today's broadcast. My program guest will be Richard Ferri. He is author of the ETF book. We're going to get into why it's a bad idea to buy mutual funds in your taxable investment account in the final 2 months of the year. We'll also talk about commission-free ETF trading, which is a big trend happening in the investment marketplace. And we're going to talk about whether that makes sense and what you need to know in order to avoid the pitfalls of commission-free ETF trading. We'll also get into some of your phone calls and emails. So if you'd like to join us to talk about a particular stock, mutual fund, ETF, you want to talk about the economy, a particular investment theme, just call the program 877-711-5611. Give us your first name along with your city, and we will get to you. If you want to obviously talk about a particular stock or mutual fund or ETF, give us a ticker symbol and we'll track it down and we'll dissect it. So let's get right to it. Let's talk about what happened with the stock market. Again, finishing the week higher. The Federal Reserve said it would keep its easy money program intact, or as we call it on the program, Qternity. So Dow Jones Industrial Average rising 0.3% for the week, closing at 15,615. S&P 500 rising 0.1% to 1761. And the more things change, the more they stay the same. The U.S. stock market continues to be in a bull market. Whether you believe that or not is up to you. Whether you believe that it's a Fed-induced rally or if it's something else, well, we have our opinions on that, don't we? Pretty much my view on that is the Federal Reserve has been injecting the wrong patient with the right medication. And, of course, they've been targeting the broader U.S. economy, and they've helped a little bit. But the real beneficiaries of QE have not been the broader economy because employment is still sluggish, and it's really the financial markets, particularly risk-on trades and risk assets, that have benefited the most from QE. Now, taking a look at the cost of living, 63 million retirees and disabled people collecting Social Security will receive a 1.5% cost of living increase come January 2014. That was a statement that came out from the Social Security Administration. So the average monthly retirement check will rise about $19 to an average of $1,294. So that's what's happening in Social Security land. And one of the things that we encourage those of you that are retired and looking to get more income from your investments, one of the strategies that we use on this program and actually at etfguide.com, which I publish along with the monthly newsletter, we do our monthly income trades on a portfolio of all ETFs, low cost. And for the month of November, we generated almost $700 of monthly income on that portfolio of all ETFs. It's a $100,000 hypothetical portfolio. And the idea is to grab not just dividend income from the underlying ETFs, but also selling covered calls, a very conservative strategy, And we've been doing this almost 2 years now. And over the past year, we've averaged just over 10.5% of monthly income, or a yield, annualized yield. And we've been just grabbing monthly income every single month by selling covered calls. It's a conservative strategy. And if you'd like to follow along with our next income trade, which will be around the tail end of November, go to etfguide.com, click on the Ready to Go portfolios, and follow us. And if you want to follow what trade we just did for November, again, you can do the same thing. Just go to etfguide.com. So how is your investment portfolio performing? We're here in the final stretch of 2013. Take a look at your investment portfolio in aggregate, whether that's a 401k plan, IRA, taxable investment account, and look at the performance relative to major market indexes. This is the correct way to look at the markets, your performance relative to the market. That is the only way to accurately gauge whether you're moving ahead or falling behind. So you take a look at an index fund, which just tracks a basket of indexes, or a basket of stocks in an index. Let's just take a look at the total U.S. market index that Vanguard ETF tracks, ticker symbol VTI. And this is a good benchmark by which to measure the performance of your own portfolio, because VTI includes the total U.S. stock market, not just large company stocks like the S&P 500, but it also includes mid and small company stocks. So VTI has gained just almost 25% since the beginning of the year. So from the beginning of the year through the market close of November 1st, how has your portfolio performed? Have you gained almost 25%? Now, if you haven't, well, that tells me a couple of things. Number one, you've probably built your investment portfolio on the wrong foundation. Number two, if you haven't been able to keep up, that means that you don't own low-cost index funds and index ETFs as the foundation of your portfolio. Why? And number three, it's time to go back to the drawing board. It's time to refurbish your investment strategy and get back on track, because 2014 is just around the corner. So now is the time to do that. We're going to talk with some portfolio strategies a little bit more in detail with my program guest, Rick Ferri, author of the ETF book. He's coming up in a little bit. We'll talk about why it's a bad idea to be buying mutual funds in your taxable investment account. And during the last 2 months of the year, we see a lot of people making the same mistakes year in and year out, and they just get crushed every single time. And so we want to help you to avoid some of these mistakes. 877-711-5611. Please join us. Now, taking a look at some of the major sectors within the S&P 500 and giving you kind of a quick update of what's going on there. Sector-wise, top-performing industry sectors thus far have been consumer staples. Consumer staples, actually check that, consumer discretionary. Consumer discretionary, which is different than staples because it's more aggressive. XLY ahead by 34% and easily outperforming the S&P 500, which has gained around 23.5% since the beginning of the year. So look at that. Consumer discretionary stocks outperforming the S&P 500 by almost 10%. So that's a pretty big margin of victory. We also see the healthcare sector continuing to hold its margin of victory over the S&P 500. XLV is the ticker symbol for healthcare stocks, which have gained just over 33% since the beginning of the year. Industrial stocks are doing good, ahead by just over 29%. And then some of the lagging sectors, if we can say lagging, you've got utility stocks, which have gained almost 12%. And that's really, as far as I can see, the worst performing industry sector within the S&P has been utilities. And really, you think about it, well, we've had a surge here over the past year in interest rates. Now, I know we've had a little bit of a pause here. We've seen the yield on 10-year U.S. Treasuries go back from close to 3% to around 2.6%. But the trend of higher yields is still in place. This is the Index Investing Show. I'm Ron DeLegge. We're here, you're there, and I'll be right back.
The Index Investing Show with Ron DeLegge.
All right, 877-711-5611 is the number. You're listening to the Index Investing Show. We're here if you want to talk about a particular stock, mutual fund, ETF. We're going to do some trivia. I think it's time for some audience participation, so stay tuned for that. Before we do our trivia question, I want to tell you about home prices, which, according to the S&P Case-Shiller 20-City Home Price Index, this is the latest data that they have provided, and it comes from the month of August. Home prices were up 12.8% from the year earlier, and that is the fastest pace of growth in home prices since early 2006. Now, I forgot what happened in 2007 and 2008. Can't remember that far back. What happened to home prices? I can't remember. Maybe somebody can remind me. Anyway, home prices are soaring. 13 cities in the index posted double-digit annual gains. Hee-haw! Back to the races, baby. I'm loving it. Let's just over-leverage ourselves. Let's take on more debt. Let's get 10, 20, 30 mortgages. I'm loving it. So that's what's happening with home prices. And home builders, as a group, ticker symbol XHB, which is the ETF that tracks this particular sector, has been a star performer. XHB, well, you've got really two ETFs that track this sector, XHB and then ITB. XHB is the Spider S&P Home Builders ETF, and over the past year, it really has reflected the gains to some extent that we've seen in the home sector, especially home building sector, ahead over the past year by just over 15%. Year to date, still posting a pretty good return of just over 11%. But nevertheless, we have seen a little bit of a rise here in interest rates. Well, I shouldn't say a little bit of a rise. I mean, over the past year, the 10-year yield on U.S. Treasuries is up more than 40%. That's more than a little bit. So, even though we've got the Federal Reserve continuing with its QE, we've seen rates continue to head higher. So, that hasn't stopped rates from going higher. So, the point here is we've seen a pause. Will that pause? Will that continue? Will the rates continue to head higher? I have the feeling that we're going to see rates edge higher despite what the Fed does. And there's a lot of other noise in this particular marketplace besides what the Fed is doing. We've got, of course, the debt ceiling debate, which is not much of a debate, but that's going to be happening again in February. And we're going to probably see more volatility, not just in the stock market, but also in the bond market. So these are some things that you need to be prepared for. Now, I know that the VIX, which measures stock market volatility, is in the toilet because there's really not much fear in the stock market as measured by the VIX. The VIX now back towards 13. Now, the 52-week low on the VIX is 11. And the VIX, just FYI, is a barometer of stock market volatility within the S&P 500 over the next 30 days. And so when the VIX is high, that means there's a lot of anxiety, there's a lot of fear in the market. And when the VIX is low or depressed, as it is today, that means just the opposite, that there's not a lot of fear, that there's not a lot of anxiety in the market. And we use the VIX typically as a contrarian barometer of the market's mood. So when the market is really happy and excited and and sees no sunny skies and sees no problems, well, it's probably time to get defensive, and the VIX can tell us that when it's depressed. And the opposite's true, of course, too. When the VIX is very high, when it's hitting, spiking, that means, well, there's a lot of fear and anxiety and probably a good time to take a look at investing and doing the opposite of the crowd. When they're selling, you should be buying. And conversely, when they're buying, you should be selling. So that's one way to play it. Another way to play it is by investing in or making specific strategic trades on the VIX. Now, you've got VIX ETFs and VIX ATTNs, which we do not use at all at etfguide.com in any of our newsletters or weekly picks or technical forecasts, just because these products, and we've seen them over the past couple of years, we've watched them very closely, they don't do a very good job of replicating the VIX's short-term performance. And this includes even those VIX ETFs and VIX ETNs that are proposed to track the short-term movement of the VIX. And the perfect example, a case study, is the 1 month period from September 15th to October 15th, where the VIX rose almost 30%. And what did VIX ETFs do? Well, the short-term VIX ETFs rose around 8%. So a pretty big performance discrepancy between short-term VIX ETFs and the VIX itself. That's why we use VIX options, calls and puts. It's just a better way, in our opinion, to play the VIX. So usually when we make those trades related to the VIX, we always use calls and put options. And some of you, I know, wouldn't want to touch that with a 1,000-foot pole, and that's okay. But the VIX is a short-term trade. It can be traded strategically, and you do it with money that is additional money. You don't do it with your serious money that you can afford to risk, your risk capital. So let's get into our trivia question. I think it's time for that. We'll get you involved. We're going to test to see how good your memories are, because my memory obviously isn't very good. So here's the trivia question. Over the past 100 years, what year was the best year performance-wise for the U.S. stock market? Was it A, 1950? Was it B, 1965? Was it C, 1915? Or was it D, 2009? So think about that. You've got a multiple choice answer. And if you know the answer, if you could identify the correct year, which was the best year performance-wise for the U.S. stock market over the past 100 years, call the program, 877-711-5611, and we'll compare that performance to how we're doing thus far in 2013. By the way, the winner will get a signed copy of my book, Gents with No Sense, A Closer Look at Wall Street, which, by the way, is available at Amazon.com. Pick up a copy. It's a great gift, and it's a great read. Gents with No Sense, A Closer Look at Wall Street, its customers, financial regulators, and the media. And be forewarned, it is a 4.5-star out of 5-star reader-rated book, and it is available as a paperback or as a ebook. So you decide how you want to read it. 877-711-5611 is the number. Coming up next, we're going to have Rick Ferri with us. He's author of the ETF book. We're going to talk about why it's a bad idea to be investing in taxable mutual funds in your taxable investment account. We're also going to get into commission-free ETF trading and give you heads up on some of the pitfalls. I mean, this is a great movement overall. I mean, the ability to buy and sell ETFs without paying any trading commission. We see major brokerage firms now offering this. We've got Schwab, we've got Fidelity, Vanguard, you name it. They're all battling for your business. And so they've done this by offering commission-free ETF trading, and they allow you to buy and sell ETFs online without paying any commission. So what are the pitfalls of that? What are the catches, if any? So Rick Ferri coming up next. We're going to talk with him. Again, if you'd like to join us, 877-711-5611, What is the answer to our trivia question? Over the past 100 years, what was the best year performance-wise for the U.S. stock market? I'll be right back after this short break. Go nowhere.
The Index Investing Show with Ron DeLegge.
You've heard them on the radio and seen them on TV. Gold experts promising big profits. The truth is, gold prices have crashed, and investment demand is down over 50%, according to the World Gold Council. While gold experts keep promising higher prices, the Profit Strategy newsletter at ETFGuide.com told its subscribers the gold bubble would pop. Our gold alert given to subscribers in early 2013 resulted in a 500% gain. Listening to gold experts would have lost you a boatload of money. Listening to ETFGuide.com would have helped you to profit. Stop listening to gold experts and stop following the crowd. Subscribe to the Profit Strategy newsletter at etfguide.com and make money. Our no bull approach is world famous, and what happens next in the gold market will shock the entire globe. Join today and get a $50 bonus by using promo code SAVE50. We'll tell you what to buy, what to sell, and when to do it. Be ready for the next big move in gold, only at etfguide.com.
It's been a good year for stocks. The Vanguard Total Stock Market ETF, ticker symbol VTI, ahead by 21%. But will it last? Here to talk with us about that is Rick Ferri. He's the founder of Portfolio Solutions, manages just shy of $1.3 billion in assets. He's also author of the ETF book. Go pick up a copy at Amazon. Rick, welcome to the Index Investing Show. Great to have you with us.
Thanks for having me back, Ron.
So the U.S. stock market trading near all-time highs, and some people say that today's price-to-earnings ratio, or PE, is a sign that the stock market is overvalued. Others argue that it's a sign of improved earnings growth in the future. How do you see it?
Well, it's probably neither. It's 18.5 times earnings, which is simply the price of the S&P 500 divided by the number of earnings, the amount of earnings that the S&P companies in aggregate have earned in the past 12 months, is around 18.5, which is, as you said, higher than the normal. The normal, if there is such a thing, is around 16. So we're slightly higher than normal. Is this a sign that the market is overvalued? I don't believe that it is a sign. In fact, I was just looking today at some more research and said if you would have bought the market back in 1961, the PE back then was also 18.5. And if you would have just held it at 18.5 PE through time, you would have earned yourself a nice compounded return of about 8.5%. So as long as if you're buying at 18.5 PE and you're selling sometime in the future at 18.5 PE or higher, you're going to do just fine.
If you're just joining us, you're listening to the Index Investing Show, talking with Rick Ferri, author of the ETF book and founder of Portfolio Solutions. Now, many large brokerage firms like Fidelity, like Schwab, like Vanguard are now catering to investors with commission-free ETF trading. This is the rage. What is your view about commission-free ETF trading, and what are the potential pitfalls?
Well, my view on free ETF trades is that nothing is free. It might be commission-free, but when you buy or sell anything over the stock exchange, and all ETFs are traded over the stock exchange, there are other fees involved. There is the spread between the bid and the ask, and there's also sometimes trading costs internal within that are shared between different brokerage firms. So commission-free trading does not mean free trading. And also, that doesn't mean that the ETFs themselves are free, because the ETFs have expense ratios within them. So putting the word free in front of something doesn't mean that everything is free. Now, are they a good thing? Yeah, I think that it's fine if you wish to invest in ETFs for the long term, and you're at Schwab or Fidelity or one of the other brokerage houses, Vanguard, that allows you to buy and sell ETFs for free, that you can, it's a way of keeping your cost a little lower. But again, you have to look at the total cost of trading ETFs, not just the commission part. But look, hey, I'm all for, keeping costs down. And if this does reduce the cost for some investors, then I'm all for that.
And then also, too, there's the cost of a limited menu of ETF choices, because this just includes each brokerage firm has its own little menu that's limited in terms of which funds you can actually purchase without incurring any kind of commission. So that may limit you from a portfolio construction perspective.
I think that most of the companies that are giving you free ETF trading, they're core funds like the Total Market Fund or the S&P 500 fund or such. The core funds where you can build a portfolio are, there's availability of free commissions on those. I think that once you get into more defined, esoteric, non-core ETFs, you're not going to find too much commission-free trading on that.
Rick Ferri, founder of Portfolio Solutions, joining us. RickFerri.com is his blog. Check it out. That's Ferri with 2 R's and an I. Now, tax-wise, the final 2 months of the year can be a poor choice for investing in mutual funds that are held in a taxable investment account. Talk about that.
Okay, so mutual funds have turnover within them, where they're buying and selling stocks within the mutual fund during the year. And a lot of times the funds will incur capital gains within the fund when that occurs. And at the end of the year, they have to distribute those gains to investors. And so if you bought a mutual fund right now, let's say an actively managed fund, and we're not talking about ETFs, a little bit different. We've actively managed traditional mutual fund right now that has gone up substantially this year because the market has gone up. You could be buying somebody else's capital gain distributions, which means you could end up paying taxes on the capital gain distributions come April, that even though you didn't make any money. That's one of the problems. ETFs do solve that problem, by the way, because without getting into too much detail, within an ETF, the buying and the selling is not actually done by the fund. It's done by a different mechanism, and so you don't have this problem most of the time.
Now, you wrote an outstanding piece at Forbes.com titled ETFs May Be a Bogle's Best Friend. And one of the points that you made is how ETFs have actually furthered the same indexing philosophy that John Bogle, the founder of Vanguard, has long championed, despite his utter disdain for ETFs. Tell us more.
Well, okay, so I have to caveat John Bogle's utter disdain for ETFs because I talked with Jack, actually, what we call him, talked with Jack about it after I wrote that piece, and he thought it was a good piece, but he thought I mischaracterized him by saying utter disdain for ETFs. He only likes he only doesn't like 95% of them. 5% or so are okay, and I would venture to guess that those 5% are probably Vanguard ETFs. But the very low cost ETFs that are tracking markets, like the Vanguard Total Market Fund, as you mentioned, VTI, if you're buying them and you're holding them, and like you were in a normal mutual fund, then Jack Bogle doesn't have any problem with it. So I wanted to start out with that point first. But the second thing is ETFs, being that most of the money going into ETFs are going into low-cost indexing type products that Jack Bogle championed starting back in 1976. Even though he doesn't like the way that ETFs allow people to trade more, he called it, it's like giving an arsonist a match. These products have in fact fostered and promoted the idea of buying and holding low-cost index portfolios. And most of the ETFs that are bought by individual investors are low-cost index-type portfolios that are bought and held for the long term. So it actually has helped promote what his real message is. And that's why I wrote the blog that said, ETFs may be Jack Bogle's best friend.
One last thing before you take off, and really quick, you talk about precision in mutual fund labeling and how it's important to investors and adds to the credibility in the marketplace. How is the mutual fund industry, do you think, doing when it comes to properly labeling their products?
Terrible. I mean, some of them are labeled well. The SEC says that 80% of the securities in a mutual fund or more, if you're going to put a label on a fund, then 80% of what's inside the fund has to be in the product that you're saying in the label. But I think that there's a lot of mislabeling going on. Even indexing, calling something a total bond market, when in fact there are no index funds that actually capture the total bond market. So you have to really kind of watch out for that.
Well, I want to have you back. We'll talk about that more. In the meantime, go to rickferri.com. That's with 2 R's and an I. Check out the ETF book. It's available at amazon.com. Rick, thanks for joining us.
Thank you for having me, Ron. I appreciate it.
This is the Index Investing Show. I'm Ron DeLegge. We'll be right back.
The Index Investing Show with Ron DeLegge.
Okay, well, I don't know about you, but I really enjoyed that interview with Rick Ferri. We talked about a lot of good things. Of course, one of the most important things at this time of year, final 2 months of the year, is not getting stuck with someone else's capital gains, not getting stuck with an unexpected tax bill, not self-destructing by buying mutual fund shares in a taxable account, especially when the performance for many of these funds is up largely, U.S. equity funds is up largely due to the market's rise. And so you don't want to subject yourself unwittingly to capital gains that you did not experience. And so one of the ways you can avoid this is by not purchasing mutual fund shares in taxable account for the final 2 months of the year. Now, we're talking mainly about the equity funds, particularly actively managed equity funds, but it can also apply to other asset classes and areas that have benefited from higher prices. So, this is one of the reasons why we like to focus your portfolio to have it be allocated not just to the right areas, but also in the right investment products that are tax friendly, like ETFs. And the ETFs largely do not suffer from this type of problem. So with ETFs, you can buy and invest in them in both taxable and tax deferred accounts, regardless of the fact that they've had a pretty good year, especially the equity funds in terms of performance. So these are just things that you need to be aware of. And part of an investing game and succeeding is not just being in the right thing at the right time and owning the right thing, but it's also about minimizing your tax bill and being purposeful in reducing your investment expenses. Now, let's get to our trivia question. We still haven't had any callers give us the correct answer. Now, you can also tweet us the answer or email it. At Index Show is my Twitter handle, and my email address, ron@indexshow.com. So I'm going to read this for one last time on today's program, our trivia question, and the listener with the correct answer will get a signed copy of my book, Gents with No Sense. So over the past 100 years, what was the best year performance-wise for the U.S. stock market? Was it A, 1960? Was it B, 1965? Was it C, 1915? Or was it D, 2009? If you know the answer, call the program, 877-711-5611. You can also tweet the program at Index Show or email me, ron@indexshow.com. I got a tweet from at Eric Weber 4. He's a follower of the Index Investing Show. Sent me a chart all about gold and how it's showing a similar pattern as it was from September of 2012 to March of 2013. And that trend is still down. All these gold bugs that predicted higher prices are absolutely wrong. Do not listen to them. Do not believe them. Do not be brainwashed like them. The price of precious metals is still down, and it's heading down. And we saw this past week gold mining stocks again sink, and ticker symbol DUST, one of our favorite ETFs this year. That's been a great trade so many times. DUST up 24% in 2 days. Can you believe that? DUST is the direction daily daily triple inverse gold miner ETF. That's a bear, 3X shares. That's ticker symbol DUST. This ETF aims for triple daily opposite performance to gold miners, and it has come back to life. But it's volatile. Obviously, it's up 24% in 2 days. It could be down 10% over the next following days. But the point here is that the trend is still firmly rooted of lower prices in precious metals. And, of course, that's impacting the shares of these gold mining stocks. The price of gold bullion, as tracked by the Spider Gold shares, ticker symbol GLD, down 21%. So that's the official definition of a bear market. When we see a market from its peak fall more than 20%, that's a bear market. And that explains the situation of not just gold, but also silver. And it's not just this year. This is not a new phenomenon. This has really been since 2011. If you look at the price of gold and silver from when they peaked in 2011 to today, they have been a losing investment, losing trade, and the worst is not yet over. Now, employers are getting more generous with 401k contributions. So you retirement savers, I guess you have something here to celebrate about, because the average total company contribution is now jumped or risen to 6.23% of pay. That's up from 6.1% in 2012. That's according to Aon Hewitt in the latest survey. The most common match, by the way, of employers with their employees in 401k plans is a $1 per $1 of employee contribution on the first 6%. So that's the most common type of 401k company match. So nice to see employers being more generous with their 401k plans. So if you're getting a dollar for dollar match up to the first 6% of what you put away in your 401k plan, why wouldn't you do that? It's like free money. Yes, I know that there's vesting schedules which basically say, well, you've got to be at the company for X amount of years before you can have that full match and take it with you before it becomes your money. But nevertheless, even if you stay there at that company for, let's say, half of that time, let's say you have a 6-year vesting schedule, you got to be there 6 years to get 100% of that match, be your money. Let's say you only stay there 3 years at that company and you leave, well, you're still going to be able to take some of that money with you. Not all of it because of that vesting schedule, but at least some of it. And so that money is a great thing. It's really an incentive by employers to encourage you to participate in your 401k plan and also encourage you to save for your retirement, which is something we should all be doing, regardless of how many bills we have. I mean, we've got to respect ourselves. We've got to respect our future. You're always going to have bills. We all have bills. But you got to pay yourself first. If you can't pay yourself first, well, you've got some issues. You've got some problems. And the thing here is that why do we work? We work for ourselves. We work for our families. We don't work for our bills. And so we've got to absolutely, no matter how stressed we are financially, pay yourself first. Set aside some money. Do it. Just put it away and set it on automatic. And over the years, you're going to be amazed at how quickly that money adds up over the years as time passes. And it will. You just have to do it consistently. 877-711-5611 is the number. You're listening to the Index Investing Show Let's go to the phone lines. We've got David in Oakland. Welcome to the program, David.
Morning, first-time listener. What do you think of DTI, the Vanguard Total Index?
Great ETF. David's talking about VTI, which tracks the total U.S. stock market. It's very low cost. I mean, you got an annual expense ratio of 5 or 6 basis points. I mean, that's fantastic. It's low cost, and most active money managers can't beat it. So it's a good core holding in a diversified portfolio. If you want exposure to U.S. stocks, that's a great way to do it. Thanks for the call, David. Let's go to our next call. Who do we have with us? Okay. Mark, talk to me.
I was going to guess 2009.
Wrong. Good guess, though. Try again. So what was the year over the past 100 years, the best year performance-wise for the U.S. stock market? It's not 2009, so that leaves 3 opportunities. Was it 1960, 1965, or 1915? The winner will have to tweet me or email me the answer at Index Show is my Twitter handle. Ron@indexshow.com is my email address. Join us again next week on the Index Investing Show. Take care.
The opinions expressed in this broadcast are not necessarily that of our advertisers, sponsors, or broadcast partners. The discussion of investing is general and should not be construed as investment advice or an offer to buy or sell securities. Listeners are responsible for their own investment decisions and results. Before investing in mutual funds or ETFs, always consult a prospectus for risk, charges, expenses, and other information. Read the prospectus carefully before investing. Past performance is not indicative of future results. No reproduction or dissemination of the Index Investing Show is permitted without the expressed written consent of its producers.